Good evening, ladies and gentlemen. It is a real pleasure and an honor for me to be with you tonight. I've been so struck in my times here, and I guess it's typical of usually false self-deprecation that a speaker says, "Oh, thank you for that lovely introduction. I wish my mother was here to hear it." But I actually have an uncle that live in Albuquerque, and so I'm glad that, that I have some family here as well, and to join you in a market that's so important to Bank of the West. Certainly under George Stanfield and Michelle, I didn't realize it's amazing she's able to do all the good work she does at the office as well. To stand each time any group is asked to be recognized, we see Michelle on her feet. It's great to be with all of you. We're very proud of the team that we have here. And as I say, it's an honor to be with you. And I must say, I'm really struck by the sense of shared purpose and community engagement that's so palpable in Albuquerque among the business leaders and others that I've seen. There's a whole range of being in 19 states. We encounter many different community groups, community organizations, and government officials. And not always is that sense of shared purpose and really community boosterism that you feel here that I think you take such justifiable pride in. So it's an honor for me to be with you today. I have a few prepared remarks and I have some slides. It's a kind of, we're not a public company as Doug is on the board of a couple. I don't do analyst presentations very often, so I'm not a slideshow guy for a living, but I also feel like when I come to a business school there should be some visual aids as well as long-winded former lawyers speaking to you. I'm going to speak about several different pieces. First, I think, and perhaps apropos to my longer remarks, you don't very often hear the CEO and distinguished in the same sentence anymore. And I'm grateful for the McKinnons, Ian and Sonnet, certainly the Anderson family, and Doug Brown and Ernest for this kind of invitation. It's a pleasure, and part of what I want to say is to talk about in this restoration of trust and earning that trust, why we could have greater respect for business leaders and for institutions in American life. I'll try hard not to advertise about Bank of the West too much, but I do want to give you some details about our background and our activities around the Western United States as at least context for the remarks that I'm going to offer for your consideration. We're a relationship bank, so there's the pieces that I'm planning to speak to. And this is the overview, as you might have guessed. Then some discussion about the financial crisis, the sort of the seeds of the problem, the current economic conditions and what we can do about it. I'll start talking about a little bit about BNP Paribas. It is, with $3.2 trillion in assets, it varies a little bit depending on the euro-dollar exchange rate. It's the largest bank in the world with operations in 84 countries. It's the 11th largest company in the world, but the largest bank. And as we've all found in the last few years, certainly through the crisis, being large alone is insufficient as a guarantee of financial stability. But we combine that size, the diversity of our exposure, and our ability to deliver a full range of products and services around the world with the great financial strength. There are only 6 banks large banks in the world that are AA rated or higher by Standard & Poor's. And while there's been some erosion in trust in rating agencies as well as other institutions, we are very proud to have that combination. And we have over 200,000 employees around the world, not all of whom are working here in Albuquerque. The Bank of the West footprint, and we also, and I'm chairman and CEO of Bank of the West and also of Bank West Corporation, the holding company, thinking of remote locations. The Hawaiian Islands are actually the most remote island group, archipelago in the world also. 2,500 miles of ocean in all directions from Hawaii. So even more remote, I'd say, by far, and I guess from the perspective of one that has a 42% market share, a very effective barrier to entry. At least a bit of a moat even in today's electronic commerce world. You can see that the map of our footprint. I just have a few statistics for you about our total assets, and the Dean was kind to mention a few of them. There's a slight difference in the two franchises, too. The Bank of the West franchise, we've grown through acquisition over the last 15 years or so. But we have a broad but shallow footprint. $75 billion in assets for our holding company is fairly substantial. You can see where we rank by deposits is the easiest statistic to compare bank sizes. But we're spread throughout the West. Indeed, we're even we have 3 branches in Wisconsin. But everything's west of somewhere. But our goal is to continue to invest and try to deepen the footprints in the markets that we find so attractive, and certainly including Albuquerque. To break down our exposure in New Mexico, just in keeping with your civic pride and our desire to be a local bank where we are. We like to think, and there's a challenge, you can either be a hybrid or a mongrel. We're not one of the largest banks and we're not one of the smallest banks. We want to be big enough to be able to, and with the opportunity to bring to bear all the resources of BNP Paribas, we want to be big enough to provide everything that any company or individual could want, but small enough to provide very local, community-based engagement, knowledge about the businesses. We like to say we're small enough to know your name, but big enough to provide any range of services that you might. You can see our exposure with 58,000, roughly about 60,000 now. This was June 30th, and we've continued to grow our market share here as well as in our western states. You can see the loans and others. We provided $27.7 million in community development loans in the last 3 years, 1,340 loans to small business entrepreneurs, and we've invested $4.4 million in community development. We're a proud sponsor of a number of local institutions. Certainly here I have to lead with the Lobos, which we support more fervently and more strongly financially than others, but we also have I've forgotten, George, what you refer to the Aggies as that school down, the junior college down the street. I'm only quoting the local expert. Ross has put up with this all day today, and I appreciate you just shaking your head rather than doing any more storming out. We also support the Isotopes, the Balloon Festival, a number of other charitable organizations, as well as good marketing opportunities for us. I tell you all that in part to hope that you'll open accounts at Bank of the West, or at least cut me a little slack, but I'd like to do it to lead into the larger themes today, as I say. Let me start with the financial crisis. We're all so familiar with it. Sometimes it's useful, though, to assemble the information a little differently and try to draw some implications and observations for your consideration. First, I'd say there's plenty of blame to go around. You remember the movie Murder on the Orient Express, and the answer was everybody did it? Now, there are varying degrees of guilt and organization, and certainly there are plenty of victims, too. But I think that the distribution of responsibility that we all need to own up to, bankers, regulators, government officials, rating agencies, as I say, and others, that allowed, and speculators, of course, to build up this level funded and fueled by undue leverage has led to undue risk-taking that caused this difficult and painful period that we're going through right now, and I'll submit for you, we're largely making our way through now. Some of it was a movement away from deposits to investment securities. That's not all bad. There are ways to have our economy grow, and we certainly provide wealth management and other services to our customers and welcome their investment in investment securities. But it added the easy access to funding in the securities markets, I think, added to the fuel. Additional financing was available from foreign investors, again, a thing that we'd like to encourage as a matter of national policy, but we have to be mindful of the consequences of that undue leverage building up. And certainly the accommodative monetary policy, hard to say at any given moment that was the time that we needed to, as I think it was William McChesney Martin that said, it's the job of the Federal Reserve to take the punch bowl away just when the party's getting to be fun. Well, we're all suffering a hangover now, and I don't remember the party being that much fun, and it's not because I can't remember the party. I think there was considerable self-delusion that fed the hubris of risk managers, of CEOs, of investors and others. And I think the length of the positive business cycle, never would we want to wish something other than that. And yet, there are a whole generation of lenders, investment managers, and others who had never really seen a downturn in the cycle, who had never seen what it meant to give away clauses in a loan agreement and the consequences in an attempt to recover, what it meant to have prudence and a little bit more sobriety in this. And I think the supervision as the government officials themselves, and I was a government official during part of that time, as Dean Brown said, I was Senior Deputy Comptroller of the Currency from '87 to '91, so my experience was really the last time we were through this, and when I was involved with the RTC and others, trying to find good ways to work through solutions. And I'll suggest later for your consideration that the ability of markets to form around certain prices and reliable outcomes really helps, it's part of the genius of the American economy, and it helps restore growth more rapidly than I think other countries that are slower to own up to their problems and slower to find a price that will actually clear the market. Once that happens, then markets form, and I think we see faster recovery. I hope we will be able to make progress in that way. I'd say that trust and shared values are important to social cohesion, and they're certainly important in financial services. An additional piece is the way our leaders speak about institutions in American life and about the erosion of trust. Restoring that trust is, I think, will accelerate growth and will allow banks and other financial intermediaries to play their fundamental role of safeguarding and hopefully augmenting savings and channeling them to the most productive uses. Without that trust and with negative commentary, some deserved and some perhaps exaggerated, it's harder to build that foundation that will allow people to have the confidence to make business decisions, to expand, to open new markets, to add on to a facility, to take chances, to hire new workers. And that trust more broadly in all kinds of institutions. We've seen the erosion of trust in or respect for celebrities, athletes, business leaders, government officials. As a former lawyer who became a banker at perhaps the wrong time, all I've got left is running for Congress, and it's a difficult time for us. But even churches and other great institutions have lost some of their moral authority in our communities, and I think that restoration of trust will advance our growth, as I say, but it's a responsibility of all of us when we see good things happening to speak about those as well. Recommitting to building that trust, I think, though, requires some understanding of how we got there. I mentioned a little bit about movement towards securitization and other assets. Here's just a breakdown. Of course, bankers love deposits and view anything that shows an erosion of deposits as a negative, even when we're selling the securities as well. First, I submit for your consideration this roughly 50-50 split. If you can read the slides, the blue is liquid securities and the orange is deposits. These are FDIC statistics from and Federal Reserve flow of funds records. By 2007, with, of course, run-up in asset prices, as well as a redirection of savings and an attempt to maximize return, we saw it trickle down to only 30% of total liquid securities. Also, please look at the bottom of the chart and see just the dramatic expansion. Now, these are not inflation adjusted, but this is well beyond inflation, the asset value run-up. It's declined some, and it's certainly recovered from the lows of 2009. But it introduced a level of volatility and an ability to channel new monies with less direction and less, I'd say, less prudence that helped inflate the bubble. Household debt certainly did the same, and I don't know if you can see both charts, both curves here. There's a lighter blue that I hope also shows up on your slide. The lighter blue is mortgage debt, and total household debt is the orange. Now, these are household debt, not national debt. We also see those, our respective shares of every American of the total debt of the country and of our municipal and state organizations. an extraordinary buildup that allowed this fuel also. It's been painful to see this burst, but probably necessary to see some of the retrenchment, and I'll talk a little bit about deleveraging. The key here, and I think it's part, and maybe we'll talk about it further if you'd like in the question and answer period, the key is its proportion to the GDP or to population growth, but it's dramatically disproportionate to GDP, the rapidity of this growth. We're now trying to, we're betting that we can grow our way out of it while we're still allowed to borrow in our own currency. It's an important gamble to get right and to succeed on for our country. Some of the other fuel, and this is, I think, the last of my, it is the last of my leverage slides, but this is, these are withdrawals of equity from home. So we hear people talking about using their home equity as an ATM machine, and it allowed further fuel. Perhaps it was to get, in some cases, I'm sure it was to fund necessary investments to start small businesses and to do other prudent financial planning. But in the aggregate, it added additional rocket fuel to the fire that led to the bubble, I would say. And this withdrawal of home equity has now been reversed. Some is repayments. A lot is payment back on home equity lines. Some, and certainly from a banker's perspective, the worst way to see deleveraging is through defaults. So what started to happen then? Well, there was a broad repricing of virtually all assets in the economy. Certainly housing, and I was actually struck to see the declines, the 27% decline we talked about at dinner last night about the extent of the housing decline in New Mexico, which seemed disproportionately large considering the bubble didn't seem as inflated here. But I'm sure this is not news to you, but it's striking to see in one place, certainly compared to national median home prices. And while the one measure, whether it's S&P or in this case the Dow Jones Industrial Average, still trading 21% below the peak of 2007. Other collateral values, I just list some of these, and I put milk prices as well because we're the third largest agricultural lender in the United States, and among our exposures in New Mexico, quite a few dairies in New Mexico. And to see the change in milk prices is also very meaningful to us, as I know, bless you, to your economy. So it's this repricing, then I suggest, is for a risk manager, where you don't see that the prices have changed very significantly. It may be true, but it bears rigorous examination to see whether there's been some reason why that readjustment hasn't happened. If it really happened proportionally throughout the economy, I suppose we all wouldn't care if we were 10% poorer as long as everything we wanted to buy was 10% cheaper. Unfortunately, it hasn't all worked out that way, and the timing and the sequencing of it can't be predicted. And in the meantime, that last 10% can be the one that put people over the edge. I show again another way of showing just a visual of the home price declines that we're all familiar with. And again, this is the S&P 500. The KBW Bank Index, that's Keefe, Bruyette, and Woods. I'm sure some of you may be investors in bank stocks. Otherwise, you're not as worried about this as some of the guys that were introduced earlier. But that decline, and I'll suggest in a minute how that's actually in some ways a good thing, because I believe that there was a over-allocation of resources in the economy to financial services in the previous decade. There was a virtuous cycle that we celebrated in the middle of the last decade when, for the first time, I heard some statesmen say, for the first time in world history, there seemed to be prosperity simultaneously throughout the world, with the growth in India and China and other more rapidly growing economies, still prosperity in the old world, and rapid economic growth in the United States. It appeared that we were in this glorious halcyon age. And it was glorious, although perhaps not worth the pain that we've suffered since. But one of the consequences of that is when that cycle reversed and there was such declines all over the world, there's really the engine of economic growth is lacking. The United States consumer couldn't bail out the rest of the world with excess spending. There weren't other rapid growth areas to the extent necessary. And we all are hoping that the Chinese economy and other Asian countries can continue to provide that growth. Certainly demand for commodities has inflated prices, and some ability to continue to fund our debts. But it's that reversal of that otherwise virtuous cycle makes it more difficult to come out of it, and we are left with, and in the case of U.S. policy, really the government as the consumer of last resort. We hear a lot, and perhaps we can talk about it a bit later as well, the contraction in bank lending. There are a couple ways that those statistics come about. One is we have many lines of credit to customers where the customers are not into their lines as much. They're not drawing the same percentage of their borrowing capacity they once did for the reasons we've just been talking about. They lack confidence to make, there's reason for them to say, it behooves me to wait another period, another quarter, another half a year before making a significant commitment. That shows in the overall statistics as a contraction in lending. Certainly there have been institutions fail. Others who need to rebuild their capital have been forced to constrain their lending. There has been a separation, it seems to me, between very creditworthy borrowers who are reluctant or see no need to borrow, and others whose predicament makes it more difficult for them to access credit. A lot of the sort of monoline credit providers, finance companies and others have gone out of business or have been merged into more heavily regulated institutions that again causes some contraction. I think the most dramatic, as I say in my slide here, is the decline in non-bank lending rather than from banking. Partly because of the difficulty, especially up until the middle of this year, in financing themselves. The capital markets were pretty closed to them, and consequently they couldn't build the inventory, they couldn't hold the inventory to finance, and would have to contract their credit appetite. So we see that the lenders are building their capital and are safeguarding it. A number of them had to receive government funds. I was afraid that was the hook, but it seems a little early to me. Even hedge funds, knowing the provenance of the endowment for this lecture series, have seen reasons to contract their exposures and to grow far more conservative, and to, in some cases, return funds, I think very commendably, when they see the paucity of opportunities. Foreclosures continue to drag, and I'd say that's part of this postponed reckoning of the pricing, of the repricing that will allow a floor to form and to markets to form around them. We're pleased, I guess I'd say as a quick aside at Bank of the West, we're a fairly substantial mortgage lender. We did no subprime lending, and we've had in our 19 states less than 200 home foreclosures in all of 2009, and again less than 200 this year. So George is able to sign any foreclosure notices without access to robo-signers or, no, I don't mean to make light of it. They are individual tragedies. We believe that through our careful underwriting and our support in restructuring and modifications that we've been able to really reduce those difficult times. But we still have, and I think the national statistics are 25% of home mortgages are now, the mortgage is more than the value, the appraised value of the home. These are perilous times if they persist, and I think it'll be driven most, as I'll suggest in a minute, by unemployment rates. I mentioned the corporations reducing borrowings, often by choice, some conservatism, but these slower growth rates, I think, are more sustainable. Consumers are doing the same thing. Consumers have reduced purchases, although we've seen a sales pickup since in the third quarter. It's hard to say for sure. We get anecdotal information. The Cyber Monday, Black Friday numbers seem to be somewhat of an improvement. We don't see it in shipping data, and so it's yet to be seen whether we're coming out a bit. It's the first time, and you saw those charts that showed the slight decline in 50 years, that household debt has declined. I think some of that is again, bank conservatism and the absence of the non-bank lenders that had, whether they were everything from payday lenders to other finance companies that may have had different standards. And of course, again, individual defaults. We're trying to have the government, and they've used every tool they had in the past and invented some new ones to find ways for the government to provide this influx of economic activity, a consumer of last resort, explicit guarantees of debt through the various TALF and other programs that have now been discontinued, direct intervention with equity stakes taken not just in banks but in auto companies and others. We now see a second round of quantitative easing, not named after the large passenger liner. The low-rate environment is good for troubled borrowers. It helps people carry on, and it, I hope, will stimulate further economic growth and that willingness to take a chance, and actually to make those more conservative bond investments less attractive that may cause people to put money at work in other ways that might fuel more dramatic or rapid growth. Although I'm sure we could have theoretical discussions, Dean, about the velocity of money and how rapidly it will get to its rightful place nonetheless. But I think having that a stimulus effect, we'll see. We have the Japanese example and others to see whether lowering interest rates to zero is enough. It's been, yes, the lost decade in Japan is a worrying example. And Chairman Bernanke is an expert on not only on the Great Depression in the United States, but also on the Japanese situation. And I think the Federal Reserve rightfully believes and has proven that they can fight inflation more effectively. And no one knows for sure how well we would do in fighting deflation. And consequently, I think the FOMC, the Federal Open Market Committee minutes, it was 2 meetings ago, it's the first time I think I've ever seen a statement from a central bank saying that inflation is below our targets. To be affirmatively attempting to stimulate inflation as a lesser evil. They don't do that because they're so confident. It is better for the troubled borrowers to hang on. It's difficult for the banks. I know there's not a lot of sympathy for banks right now, but we can only lower what we pay on deposits to zero. And we're working on that. The things that we get for free. The Bank of the West has one of the strongest funding bases. 27% of our deposits are demand deposits, checking account for which we pay no interest. There's a small amount also where we pay a relatively nominal rate of interest, checking plus interest accounts. And yet, right now, that deposits are not as valuable. The system is awash with deposits. The strong balance sheets of the corporations, they're keeping their cash ready, again, unwilling to commit it. And I think we'll see a period where there's a drop-off in deposits before there's a pickup in lending as they take advantage of that additional positioning. It makes these low-cost deposits less valuable. And I think in time, the whole system will be more stable if we were closer to more normalized rates, hopefully with still a positive yield curve that allows there to be a higher return for willingness to leave money for a longer period. Let's talk some about economic conditions now. We've seen some pickup in nominal GDP, in real GDP. We have now an estimate of 2.8% positive. Most economists say it takes 2.25 to 2.5 to just maintain stable employment. We have still a very persistently high unemployment problem that leads to so many other, it's bad in itself and leads to so many follow-on consequences. You can see, at least on this curve going back to 1970, the steepest. And we have the years sort of more closely bunched together to fit it all on the screen. So when you hear talk about whether there's going to be a V-shape or a U-shape or an L-shape recovery, I'm showing you a V, but I don't think the steepness of that curve really does justice to the extent of the current malaise. And actually, the extent of, I guess you can look at the 1982 after I'd say the defeat of inflation by Chairman Volcker, the rapidity of that morning in America again in 1982, that showed that very rapid improvement. We'll see whether we have that same rapid improvement. There's some expectation of, I don't know what law of physics that would be, that the rebound should be as steep and as rapid as the decline. It doesn't look like we're going to see that in our situation. I just showed you just the New Mexico versus the national GDP. I think it's a little more volatile. I'd say it's better, but it's more volatile, I think, mainly just because of diversification and size, where smaller amounts can swing the local results more dramatically. But certainly, New Mexico, even with the great support of and government funding of the labs and other high-tech leading industries, is certainly not immune from these national problems, as you know. Certainly doing better in unemployment, however. I don't have, and I don't think there is yet available a November New Mexico number. The 8.4% was October, whereas the 9.8 national number was last week's number from the Labor Department. I think, and if you really think of it, as New Mexico consistently has outperformed for many years. It's not clear that the data are perfect, that every discouraged or underemployed worker is properly counted. These are people, unemployment statistics, as you know, who are actively seeking work and are unable to find it. But still, through this period, New Mexico's done a little better, or in some cases, considerably better than the national averages, certainly going into the crisis. It looks that New Mexico was one of the last in. We have a similar experience with Hawaii, but we'll see how fast, if it can avoid much of the depths of the problem. Hopefully, with the restoration of confidence, as we're talking about tonight, some of those problems can be avoided. To give you some perspective, California is at 12.4% now in unemployment. And we will not see sustainable economic growth with that many people out of work, reluctant to buy the new house, buy the new car, or find other opportunities. So let's talk a little bit more on our actual subject for tonight about rebuilding trust. I think traditional banks are resuming a larger role in the economy, and in many ways that's a good thing. All of our careers, we've faced what we call disintermediation, where there's no need for the financial intermediary and people can interact directly in the credit markets or find other ways. And that efficiency has helped fuel our growth. It's a good thing. But the role of banks as steady, consistent, reliable lenders, just as we feel that we've been because of our financial strength, that we've been able to go through the crisis with available credit and a safe place for deposits, that role of banks that they're willing to shoulder is a valuable thing. The value of deposits, I was just telling you how they're not worth very much because they're the rates are so low. And yet, certainly in the depths of the crisis, and I think all through, that's part of that reconfirmation of the value of deposits, the stability of a funding base. When we saw the large investment banks or other financial intermediaries who needed to be able to sell commercial paper weekly and find ways to finance themselves, when those markets were closed to them, and they didn't just taper off, but slammed close on them. The core deposit franchises, the true value there was certainly very important. And it's just why, among other reasons, we saw in the depths of the crisis, even the greatest storied names seek bank holding, that's what a BHC is, a bank holding company, to seek bank holding company status, access to Fed programs, and ability to accept insured deposits. And I think, in the housing, when we're looking particularly at the housing markets and the declines in prices, the much dried up availability of housing finance from monoline mortgage companies certainly contributes to that difficulty. I suggested a minute ago that there's been sort of an over-allocation of society's resources to financial services in the past. One way to show that, I think, is if you look from 1998 to 2006, the rapid growth of the percentage of the S&P 500 represented by financial companies. I'm hardly qualified to speak to you at all, but I certainly am not to try to allocate resources in society. But it seems that when our best engineers go to be inventing financial products, it's a challenge for our long-term economic growth and for our country. And I think this sort of reversion to this mean, at least the 20-year average at 15%. Of course, they can move new companies in and out, but those that manage the S&P 500 try to mirror the economy. And I think I found this a dramatic indication of how values had changed and how perhaps we're now going to stabilize at a different level. Part of that will also be the reduction in leverage in financial services, whether it's higher capital requirements, new liquidity requirements imposed by both U.S. and global regulators, decisions made. You probably have been reading Jeff Immelt's comments in the New York Times on Sunday about GE Capital and the role in the company as a whole. I think many are seeing that a sort of liquidity-driven, leveraged model is less sustainable, and because of the depths of the declines, is not worth the froth in the best of times. So I hope you find that to be an interesting way to depict that. Some also is just the nature of regulation, and we'll certainly see how the regulatory authorities, it's human nature to perhaps overreact. I know that they are guarding against overreaction and trying to strike an appropriate balance between fiscal and financial stability, systemic stability against economic growth. The two needn't be mutually exclusive, of course. In fact, I think a stable base will give that confidence that we're talking about, but stable at a sustainable level of government involvement in the economy. I think the intellectual edifice that Chairman Greenspan's talking about here is really the belief in continued growth and efficiency of the market and the ability of the market to self-police. I think there's much less reliance on that now. How the new paradigm is developed to substitute for that, the stakes are high for that. So I say for your consideration here, it really matters how the lessons from the crisis enter into the common wisdom of society. How people, if in a future debate you can say, well, as we learned in the crisis, we must, if everybody starts nodding along right then you're going to get whatever you put at the end of that sentence. And the stakes are high because of the role of banks and of financial intermediaries in the economy on how that new balance is struck. I think it is a key for future decisions. I think it's appropriate for there to be a somewhat greater mistrust in models, in black boxes, and other, even for regulatory purposes. As sophisticated as our modeling is and as useful as it is, it's a useful tool as a check, as a conversation starter, but it can't be the autopilot that lands this plane by itself, as we were talking about earlier today. I think there has been some rejection of market forces, and as someone who worked in the Reagan White House, as Doug said, I find that distressing, and it's important that our faith in markets be reaffirmed, as well as our faith in our economic intermediaries. Some of this is just the consequences. Further regulation is the consequence of increased complexity. Certainly the interconnectedness between institutions, when we try to address, our leaders in Congress elsewhere have tried to address too big to fail issues. We recognize the extent of the interconnectedness, problems in other parts of the world or otherwise apparently fairly small institutions. A serious debate took place the weekend of Lehman's failure, or decisions on which institutions had to be supported in the national interest. That interconnectedness is an interesting lesson. Increased regulation, it's an obvious price of massive government assistance. Now, it's great that the government's making profits on whether it's the Citigroup repayments today or other TARP funds being repaid with interest, and the equity positions taken being more valuable, the success of the GM IPO, for example. It causes increased costs, and those costs are not just banks. And so as much as you want to beat up on the banks just out of some retribution theory. Those costs are passed on, and because of the role of a leveraged intermediary, there's a multiplier effect as those costs are imposed in financial services. Certainly higher capital and liquidity standards, I think, will restore public faith. We're pleased to have very strong capital at our bank level as well as at our parent company. And then there's the natural congressional reaction. When Sarbanes-Oxley passed 87-0, I think some wag said anything that passes the Senate unanimously has got to be a mistake. The extent of the re-regulation is not fully recognized yet. We don't all know what it'll be, and it adds to this uncertainty of costs that I think may freeze economic actors. For example, any bill that's 2,319 pages long, I won't try to guess how many members actually read every page. Approximately 250 regulations, their rule writing and instructions, because they couldn't put it all in the statute, and I think they needed, in order to get things passed, they need there to be ambiguity that will be sorted out by the expert agencies in later regulations, and some that they need more study on. So they commissioned 67 separate studies to be done and 22 new periodic reports to the Congress. I think it has reduced the odds of systemic failure, and catastrophic losses are things you ought to insure against. And it's worth spending some money and paying the price in slower growth and reduced leverage in order to do that. I think that there's another benefit of the likelihood, or I say here, the potential of similar regulatory approaches to similar activities. I've been derogating the monolines and the finance companies and others, but with this new Consumer Financial Protection Bureau, I hope that similar rules will apply to all providers. It should be done, it seems to me, not by the nature of the charter, but rather by the way you interact with the public. And if your interaction is about credit card lending, there ought to be similar rules, or mortgage lending or any other finance. That from banking business that is distressed about being tarred, I think sometimes unfairly, with the brush of problems of the unscrupulous, it could well be a positive development. I think the steps towards international harmonization are also valuable and necessary. It's, as we can see, international cooperation is hard to hold together, whether it be currency unions or just agreements among supervisors in the smaller town where the Bank of International Settlements is based in Switzerland, in Basel. But I think those are valuable, and those national guidelines on capital, on accounting standards, I imagine there's quite a bit of discussion in the business school about harmonization of accounting standards. We certainly see big differences or occasional differences in generally accepted accounting principles under which we manage the Bank of the West, and international accounting standards under which BNP Paribas and others report. There's some, I guess, national pride, but by and large, I think there's room for good accommodation there, and I see progress there, and I expect that will bear fruit in the near future. Well, I've talked about balancing different goals. Another factor is concentration of deposits. This is just one measure. It's harder to get, even with fewer monolines and others. It's harder to really show market share as easily in lending as it is in deposits. And the deposit data are easy to get. They're all, yes, there are CDs and there are checking accounts, but it's basically homogeneous and can be easily analyzed. Here's just one measure of concentration, and these are U.S. deposits in the top 5 banks. A few of these, and the small banks don't have foreign deposits, but for example, Citibank is shown here or Citigroup at 3.7%. I think if you included their foreign deposits, they'd be closer to 10%. So the concentration, you may have seen, there was an article that showed 46% instead of my 37.8. That's with foreign deposits as well. By any measure, though, and especially with our populist traditions and fears and of aggregation of economic power, whether it be Jacksonian railing against the Bank of the United States, or our legitimate concerns about accumulation of power on a fundamental thing like money. it can be troubling. Now, by contrast, in Europe or in other parts of the world, our markets are very fragmented. For the 30 years I've been doing this, it's been, we've always talked about barbell-shaped curves with lots of small banks and a few really large banks with about equal amount of assets. And the thing you didn't want to be was the bar, the hybrid, the mongrel instead of the hybrid. The bar has raised. The definition of what is a middle-sized bank is constantly changing. There are some efficiencies, certainly in distribution, certainly in advertising, brand recognition. There may be deficiencies if some institutions are deemed so complex that they're difficult to manage. The risk management aspects may not bear out, even though we all believe in diversification. But it's, I thought it was an interesting consequence of, I think, partly of broader economic trends, but also of the crisis, because some of those certainly, whether it's J.P. Morgan with WAMU or Wells Wachovia or others, some of that growth and the consolidation has occurred as a result of failures. Well, I tell people I'm a pretty optimistic guy. I whistle when I walk down the street. But as a manager and partly responsible for the roles we play in the communities and safeguarding people's deposits and savings, we have to be managed conservatively. We see some stirring of economic growth. Our pipelines are small and middle market business lending. Undoubtedly, it's because of Michelle's leadership, but we're seeing good growth here. Our pipelines are stronger now than they've been in 3 or 4 years in New Mexico and throughout the Southwest. Most of these are small and middle-sized companies. We're often told by our political leaders those are the engines of economic growth, certainly of new employment. And I think there's reason to feel some optimism there. The pace of growth is so restrained, however, it seems to me, by the headwinds we face. The persistence, as I said before, of unemployment, very troubling. The global uncertainties that seem to roil our markets, be it whether a few years ago Russia or the Asian crises, certainly now just the volatility of our markets in response to news from Ireland or Greece or elsewhere, I think causes us all to want to just hold in place rather than take new chances. The long-term worry of fiscal deficits, despite the best efforts, including of great New Mexican Pete Domenici, I met with maybe, I guess now, I said last night, 3 weeks ago, I think four weeks ago, he and Alice Rivlin came to speak to our board of directors of the Financial Services Roundtable in Washington. And Alice was a member of this commission that's the Erskine Bowles and Alan Simpson. It's heartening that there's serious talk about the extent of these problems. It just shows the depth of our reason for concern that everyone was surprised that it got as many as 11 votes on the commission. But our willingness to at least begin to address some of these subjects is both, I think, is heartening, but the depth of the problems as they're laid out by these commissions is also discouraging. The room to maneuver, by that I mean really the instruments of monetary policy. We've gone into the crisis, we've used all of these different techniques, including this quantitative easing. Our ability to continue to borrow or print is not limitless. And I think that's a further reason, as the tools are somewhat used up, is a reason for further, at least to be wary. But there's the remarkable resilience of the American economy that's overwhelmed the pessimists for generations. And I think certainly the educated and motivated workforce, including those educated at UNM, you see the spin-offs, the discussions that you've had. The dean was telling me about some of the patents that have been won by engineers and business people from the University of New Mexico. That innovation continues and is certainly encouraging. I put rule of law not just because I'm a lawyer, but I think when we compare investment in different parts of the world, the ability to have a much greater certainty of the outcome. Whose property is this? Can you recover? Will this contract be upheld? Can you trust the other side when they sign something? That's a thing of value that we underestimate, I think, as we compete for business and investment from around the world. And I think that adds to the efficiencies of our markets. The efficiencies of the markets are going to be slowed a little bit by re-regulation. Some may well be necessary. Some flash crash indications of how the rapid trading or other things, maybe there's more efficiency than we need some days. But I think that, again, helps attract capital. And certainly it's proven over and over again in times of trouble that treasuries rally, that the dollar strengthens, that our position as a reserve currency is still unmatched. But this uncertainty that we've been talking about slows economic growth. We've had different measures of volatility. We see the market go up 200 points, down 200 points, back up day after day without any real significant news that should have moved it. We've had 3 so-called wave elections in a row where things have changed forever, and at least for 2 years. That leads to this reluctance to invest and spend, as I've said, uncertainty about valuations. Some of it is the pro-cyclicality of regulators, of appraisers, of others. They have to look backwards, but the only comparables they have are bad news stories from a prior time that can be self-fulfilling prophecies. And then I'd say uncertainty about government action, particularly as I try to give you with all those statistics about the Dodd-Frank bill, just as an example. So what can we do to restore trust? Well, I think we need to bring closure to some of these national debates, or at least the need to find villains. I think the banking industry needs to demonstrate the lessons learned. It has to accept responsibility for its role, as I say, along with others on this Orient Express, but nonetheless its significant role. I think rational fees evenly spread across those who are buying products, so that the products aren't given for free to certain customers, somehow subsidized by excessive fees charged to others. Transparency in our operations, I think, helps restore trust. Executive compensation, again, another place that everybody can relate to that needs rationality and needs to be done at a defensible level. We have to not be, at least bankers, and I hope all of you will not be shy in speaking out about the good roles, whether it's roles in charitable organizations, in universities, in building and financing people's dreams. I think those are our keys. Our role as safe stewards of savings, our commitment to providing access to others. We had a chance during the reception to talk about Operation Hope that I'm proud to serve on the board of, or the FDIC Advisory Committee on Economic Inclusion, as we strive to find ways to serve the underbanked and unbanked communities and to improve the level of financial understanding. The move now to financial literacy, now financial capability, is both heartening and I think something we should be proud of and take personal interest in. We're having difficulty finding a good way to measure a sort of baseline of financial capacity, but we're working on that, and some Fed economists are, and the Gallup organization is donating time, and their statisticians. But if we could if every actor in these millions of transactions that take place around our country every day, if every participant in those transactions was just a little bit better informed, made a slightly better decision, didn't fall victim to a predatory lender or others, or perhaps understood a little bit more about the power of savings that caused just a slight change in behavior and perhaps some delayed gratification that allowed for savings. The significance of that, the aggregation of all those little improved transactions could make a real difference. And that's why we are so eager to support financial education. We believe that wise customers will choose Bank of the West, of course, too. We've come through a great deal together, but we have come through it. We haven't seen the robustness of the recovery, and maybe it's just that it feels like you've slowed down even more when you get off highway speeds and you're on the off-ramp. It seems like you've stopped. But I think the level, yes, of course it's relative, but the ability to withstand this and to see the improvement is encouraging. And finally, I just say that for us, with transparency, with willingness to speak candidly about our good financial condition, makes it easier to speak candidly, of course, that we believe that safe, simple, and straightforward sells. I think it ought to particularly resonate in a state where there's a town called Truth or Consequences. And we believe it and live it. And so I think together we have to first earn that trust, then repeat why, and then demonstrate it through transparency and fair dealing. I appreciate the chance to be with you and to be with this distinguished audience. Doug, it's an honor, and Mr. and Mrs. Anderson, thank you very much. Look forward to your questions.
Thank you. We have two microphones roving around to intercept your questions. So please fire away, Michael. Thanks. That's very provocative.
We have one here, Bob. But they're recording, so if you wait for the microphone.
Thank you very much. I have two questions. One is probably very simple, and one is, I think, complex. At least in my mind it is. The notion of home ownership in America and the changing of generations. What do you see the difference between that belief in it through the 50s and 60s and 70s going into the 2020s? How is that monument of America being looked at by future generations? That's the first question. The second question is, I don't think...
And was that the easy one or the hard one?
Okay. The harder one is the one that we've had such a hard time with, our generation. That is the acceptance of globalization. And as the leading country forever, we are losing that track, seemingly, not that we are not the greatest country in the world and the greatest place to live, but there are so many non-countries of not that ilk, that it seems that with globalization and the averaging out of all the toughness in the world and the bad places to live, that it's going to give a very heavy weight to America and our future, because as we globalize, we're going to be sucked up in a lot of that badness.
Yes.
And how do we react, and where do we end up 20 years from now?
I don't know if I can conflate these two and suggest that we better buy a house and that has a basement that we can go lock ourselves. No, I'd say first on the home ownership, the social good of communities, the idea that people will feel more invested in neighborhoods and take more care, I think still bears out. I don't think that the problems of the housing bubble were that too many people owned houses. They just owned houses that they couldn't afford under terms they didn't understand.
But it scared people.
It did, and it has scared people. And I think there'll be a reaction naturally there. I think there is well, it applies to lenders too, but there was an expectation for people of our generation that buy the best house you can, it'll be the best investment you ever have, and it can only go up, or if it goes down, it'll only be a little bit. My daughters are in their 20s. I don't know that they're necessarily going to think that that's absolutely the gospel. I think, and perhaps, but I suppose there's levels. In my neighborhood, there are a lot of apartments as well as houses. People who live in the apartments seem to be good citizens and take good care as well. But I think that sense of an ownership society, if they're also reluctant to buy stocks because of what they've observed or other ways to invest in American prosperity, that overall reaction is a bad thing for us. And again, will slow down some of the innovation and daring that led to the great generations before them. But I'm sure that everybody in 1940 didn't think that things were going to be, that the 50s and 60s were going to be a time of tremendous American leadership and prosperity. So I don't want to be too negative, but I think it's probably just as well that people evaluate investment opportunities and the best course for their own future on individual analyses rather than just on a formula that's in part inspired by a government subsidy. On the globalization point, it's a difficult thing. There's a human nature aspect where there's a relative performance as opposed to absolute, and people tend to, here I am, psychology, but I've read studies that say that many people would prefer to have a lower standard of living as long as it was superior to their neighbors. And yet, in globalization, I think, Bob, we're seeing if you believe in the efficiency and the distribution of where labor should be and where other things, in theory, our standards of living are improving, even though our relative gap is narrowing. I think there's danger in that going a little too far, too, because sometimes, just like you can have overcommitments of resources to financial services, the money and investment can move a lot faster than a new plant can be built or other things, so that if you decide or the market forces cause a readjustment or there's a national security reason to have capacity here that's been moved away for what appeared to be good economic reasons to the individual companies making those decisions, it's very difficult to sustain our national advantage. So I think in general globalization is a positive thing. We want people to be so prosperous that they can afford to overpay for the products we sell them. But we want to have some products of our own that we're selling them. We can't just have, I've forgotten, I had some very successful business person say, well, what would you rather have, your kids be working in a factory or being the one that designed the product? And I said, well, but there are only a couple guys that design the product, and we need thousands of people to be at work. So I think that you can go too far in globalization and the distribution of resources as much as I'm a fervent believer of Adam Smith. Yes, sir. There's a microphone here for you. George.
I'm going to ask the first question in a different way. About 40 years ago or so, maybe more, Congress felt the savings banks and savings and loan needed a friend to grow the mortgage business. And ultimately, Fannie Mae and Freddie Mac morphed into publicly traded companies. And of course they failed. And we don't talk about it, but they have failed. Mm-hmm. Shareholders are wiped out. But they're still controlling the mortgage business. And I perceive this as a significant financial overhang on mortgages, that when they're ultimately liquidated, mortgage rates will go up, and the housing market isn't coming back. How do we solve the Fannie Mae, Freddie Mac problem?
I think we need to find, we need a transition model, George, I think. You have a restricted view. It could be by choice. Do you like this better? The transition from now, where especially during the crisis, they are, I don't know what the latest statistics are, but a very high proportion of all mortgages made in America are sold to Freddie and Fannie. We sell all of our conforming production at 4.5 interest rates. We don't want to keep 30-year mortgages on our books at those rates. And so, as you say, if were it not for them, it's likely that the rates would go up some. Some of the economic analysis, though, and usually by Congressman Baker when he was leading that charge from Louisiana, would say that the value of the Fannie Mae and Freddie Mac subsidy only returned a relatively small amount to the economy, and we now see the enormity of the exposure of the taxpayer to it. I think I'm a believer in market forces, and I think you need to break it into smaller pieces and phase them out. I don't think you can turn it off one afternoon. But I think we'll see a lot more in a new Congress, especially with House oversight committees chaired by Republicans. I think we'll hear more about Freddie and Fannie. And perhaps, and I think the President's been quoted to say that there was a need first to address some of the more immediate concerns and respond to the crisis, then turn to the GSE reform, the government-sponsored enterprises reform. But it's the size of that overhang, I think, is still understated, even though the numbers are more than we can bear.
So you talked a lot about
Jason.
The return to equity-based securities, increased liquidity requirements, and kind of a return to traditional banking quite a bit. How do you see the new role of micro-lending, especially in terms of crowdsourcing, the ability of consumers to actually actively control their own wealth in terms of equity investments on a private basis outside of traditional banking?
Could everyone hear the question over there? I know he had a microphone in his hand, so if this one works, so does that one. First, I think the role of microlenders, I mean, whether it's the examples, the very inspiring examples from India and the Nobel Prize winner, it's encouraging. I think it is, it's even more traditional in many ways than our more evolved financial system now. These are small credits available from family, from communities, from local groups. We support some also, some through our banking of the philanthropists that support them as well. BNP Paribas in Africa in particular, but around the world, has been active in micro-lending. It's kind of hard to put up really impressive statistics because they're micro-loans, right? Because when people are talking trillion this and 100 billion that, even when you add up all microloans in the world, they're relatively small numbers, and yet they could be the whispers that turn into the roar as they fuel economic growth. I think of that as traditional banking as well. It's sort of credit sharing among affinity groups. I'm trying not to say credit unions. But it is or what credit unions were supposed to be before the abuse of the tax privileges. I'd say it is, I think it's really exciting and encouraging. It's hard for traditional banks to play a large role in it, but we have to get beyond the dabbling for public relations purposes. And the real opportunity, I think, is to see how these enterprises graduate. And some grow pretty rapidly into regular customers of ours, or any banks. We're not a big, I live close to Silicon Valley, but we're not a big tech lender, for example. I mean, you need an equity return, and we'll get to individuals moving to the equity accounts. You need an equity return to make up for the home runs, to make up for all the losses, or the dry holes, as the people in Roswell would say. It's if we can, all we can foreclose on is one Honda Accord and 2 electric guitars. It is, so the micro lenders can help create the conditions that lead to that. As far as individuals directly purchasing equity securities, if I'm hearing the question correctly, I think it's a great thing. We need people to, and I think actually there'll be some great rewards for people willing to take those risks. We're seeing some movement now. For the first time in I think 18 months, we saw a little bit more money going into equities and out of the bond market. At bond yields at these levels, you'd think that would be true. There's a great rush to issue more debt for big corporates now at these rates. It's back up the truck time. But it is, I think, the movement of individuals, and I guess it's even related to the questions about housing. If we're going to have an ownership society, individuals who have stakes in enterprises through their equity investments ought to have some of the same social benefits as the stake you have in a neighborhood when your home's there. So I very much encourage that. I wish mine would go up. I saw a couple of hands over there, and Dean, whatever you... Oh, you see? Yes, ma'am. Sorry.
Can you hear me?
I can hear you. I can't quite read your name.
I agree
Helena.
with you that we have to rethink policy-making changes and regulatory changes to get things going in the right direction, which includes rethinking how we do things and how we've always done things. For instance, Federal Reserve was created in 1913. Before then, there were periods where there were no central bank in charge and so on and so forth. There are a lot of people who blame the Federal Reserve for directly contributing to the housing bubble and the current crisis. How do you see the Federal Reserve's role in the future?
It's an honor to be the CEO of a holding company supervised by the Federal Reserve. I think the Federal Reserve has performed remarkably through the crisis. Now, I'm sure that in hindsight there'll be many academic studies and others about what could have been done differently. And I think many will be written by Fed economists and others who are participating in the battle. But it's you know, thinking of the old Teddy Roosevelt quote about it's the person in the arena that you should admire, not the one who's filing a critique from the back row. I think reading these gripping stories of the meetings on every Sunday night before the markets opened in Asia and what would the new announcement be, and just when you thought it couldn't get any worse, here's some new catastrophe. Their ability to maintain their equanimity and good judgment through that time, I think as, I don't know, I don't want to speak too broadly, but rescuers of the world economy, they deserve a great deal of credit and thanks. Sure, they, as other, I'm sure there are studies by various reserve banks about at what time should the accommodative monetary policy of the 90s been turned down. What should our response have been to, or their response been to the dot-com bubble bursting? Was too much liquidity flooded into the markets after 9/11? Perhaps, but those were, I was general counsel of Bank of New York on 9/11. I was a couple blocks away. I saw the second plane hit. Those were turbulent times in their own. And the desire and the sort of standard operating procedure for a central bank in times of crisis is to provide liquidity so that more stability happens. It's a longer term piece, and I don't think I can ascribe the same level to it, but one of their functions as a lender of last resort is to make loans against good collateral for companies that are being unfairly, or where there appears to be an irrational market reaction. And I'd argue that the return of the government's money and its investments in some of these special programs with a profit to the taxpayers is much longer term, but some validation of the ability, the creditworthiness of those companies at the time they made the liquidity available to them. So I'm an admirer. I have friends that are governors that are directly engaged, and I think their patriotism is unquestioned, and we're very fortunate that we had people like that in positions of responsibility in a time of national peril. Yes, sir.
I believe that being said, I don't remember the exact statistic, but that Bank of the West had the highest customer satisfaction rating among all banks.
What a nice question. Oh my God. The J.D. Power and Associates does a review of the same people who've earned more credibility in the marketplace for their autos and other customer satisfaction. And they break it down by different regions. So they had the Western United States for the previous 2 years, and then last year it was California alone. There were separate rankings in Colorado and other places. And there are international studies like this too. But yes, we are proud to, and our teams have earned the respect and satisfaction of our customers. Both the frontline people and I'd say also our technology people who can safeguard identities, who can resolve problems swiftly if they do occur.
Okay, you're probably going into the real question was, congratulations on that, but first of all, what would you say are the main factors that have contributed to that? I would imagine strong leadership that permeates the organization and the corporate culture. is a big part of it, but especially that consistency over 3 years. What would you say are some of the main factors that have contributed to that?
I don't want to get too much of a big head about it. The winners, the 2 years prior to the 3 years in a row we won were Downey Savings and Washington Mutual. Neither of which is with us. And I think, I have to be careful with speaking, I have 2 microphones. At least they're on the same side of my mouth. It is, I won't even, well, there can be decisions that are business decisions that are not the ones we've taken to provide a level of service that's satisfactory but not outstanding. We are this in-between size. We pride ourselves on service. We can't afford the full advertising campaigns of others, and so we can be shouted down in the marketplace if all we can say is service and somebody else says service 10 times more often. It's very important to us that we get the validation of respected third-party reviewers. I'd say it's because of the commitment of the people, which, as you quite rightly say, and I think it's a harder thing to teach, but important to recognize in a business school about the importance of a corporate culture. It's certainly from leaders like George and Michelle and others and Mike, but it is it's the individual who wants to go that extra bit to unlock the door, to say, let me stay on the line until I get the right person for you. We still have our phone numbers in the telephone book instead of the 800 number. Now that's a little more expensive. There are a lot of our customers who are not profitable to us. We would like to have them give us a bigger share of their wallet or find new ways to serve them that are less costly. And some technologies that internet banking allows a great deal, and the quality of our internet offering has improved dramatically. So I think it's now as good as anybody's. And that leads to satisfaction as well. I think some is not to our larger theme tonight, is to be straightforward about what you offer, not to make false promises and stand behind it. But I think it's really the feeling that our people own if there's a problem or a good result, that it's theirs, and that they're committed not just to following a certain procedure, but to make the result the one that the customer wants. Man, are there any more questions like that? Yes, please.
My question centers around job growth, and absent the advent of a new technological revolution over the next 3 to 5 years, where do the national leaders really see true job growth coming from, other than the healthcare industry? And the second part of the question is going to be centered more on the discussion about a potential new norm of unemployment rate. And is there truly a new norm that they believe is going to be centered in the 5 to 9 to 10% range, in that medium? Or is it more of just the future demand for construction that was brought forward with all the accommodative monetary policy, and was that lag then eventually going to get brought up in terms of over the next 5 to 7 years we'll see the construction industry start picking up and those jobs coming back?
That's a really good question. I certainly hope that the structural unemployment I think is still called. It used to be when I was working in the government, everybody would say, oh, there's a structural unemployment, so real full employment is closer to 6% unemployment. Of course, you'd never want to acknowledge that. There is a mobility. Right now, there's less mobility in our workforce. That's one of the things that's helped American growth faster. Some of it's education, some of it's willingness to move across country to where the new job is. And as interrelated as all these things are, when you've got negative equity in your home, or when there are several jobs that are in the family that you're trying to juggle and decide what opportunities present themselves, it can slow that flexibility in the economy. I think it's true and statistically invalid that small business is the place where more new hires happen. I sometimes think larger businesses don't get full credit for being the ones that gave the order to the small business that caused them to hire the next person. But I think that growth through innovation, I think just as it was too bad that so many I was talking to a guy from Michigan earlier tonight, but I remember Ypsilanti, Michigan decided that they would be the Silicon Valley of the, Chippewa area, and everybody had that was their strategy. And now it seems clean growth or green projects are certainly attracting a lot of venture capital. I don't think that they could be generators directly of themselves of the amount of job growth that we need. But it would be great to see following on innovations here, and they don't have to be heavy industries, but to actually make products rather than export services, I think would be a real positive. I think that the places those come from are investments in higher education, in laboratories and basic science that spins off, whether it's all the things that came out of defense spending, actually, that have been so valuable for civilian consumers. Those benefits, that it looks like it's an easier thing to cut in a difficult time, and we all know that we're going to have to cut some things that we'd hate to, that we view as essential. But I think that the follow-on value of investment in fundamental research is so dramatic that I hope that that can continue. So I think that's really where the job growth will come. It may come because big companies make orders for the producers of smaller products that go into their manufacturing or other parts of their process. Now, there's nothing dishonorable about being in the service industry, but I don't think we can only exchange money among ourselves and see significant growth. Yes, ma'am.
You mentioned the...
There's a microphone right here for you.
Hi, I'm Rebecca Solomon.
Hi, Rebecca.
You mentioned your delivery of services using the internet as part of the reason why you're tops in your field, which gave rise to the thought of how is banking, and specifically your bank, preparing for what I see is going to be the collapse of the U.S. postal model in order to deliver information to your consumers. I work in an industry where we just get all kinds of statements from all kinds of different banks that we have loans with, and I just couldn't personally, as a personal and executive assistant, keep up with the number of windows I'd have to have open on the computer and to keep them safe so that our server could not be, some imposter might try to intervene. So how are you preparing for, suddenly, like I would predict in 3 to 5 years, the postal model is just going to disappear. A lot of your consumers are still opening bank statements.
Well, the efficiency, and because of cost pressures, people are moving more and more to those delivery models. For us, ATM machines and others are also, I was telling somebody the other day, I like personal interaction. I'm 55 years old. I used to want to go, when I went to the airport, I wanted to talk to somebody at the counter. I didn't want to go to one of these little ATM kiosk kind of things. But now I find that I get perfectly, it turns out they don't have that much to say and they don't think my jokes are that funny. And I just want my boarding pass that has the right gate and the right seat assignment. I believe that people will still feel that they're getting quality of service, and I'll get in a second to your point about security and the internet. Of course, we recommend that you consolidate your accounts in one great bank and you don't have to have all those windows open. But while you're moving to that decision, I think the amount of investment we're all making in the security of our electronic data source systems, our delivery, we want to be able to communicate. We don't want to be put on your spam list, though. We want to have valuable information for you. We'd like to approach prospects as well as existing customers. The bad guys, though, are investing lots of money also and have some great minds behind them to try to find new ways to fight through the security barriers that the banks erect. And it makes it a little less efficient for customers because we have to have those levels of security. But I view it as a fundamental responsibility. There's reasons why the old bank branches all look like the Parthenon. We want to show stability and security and reliability. It's much more difficult to do that if you're just yet another website and you can't tell whether it's your bank or some scam artist. And so it's a challenge for us to continue to invest try to stay ahead of the hackers or others that might have nefarious ways. And there also, we feel a responsibility, but we want to put the technology in our clients' hands. There are many of the attempts to steal are to go into the server at the customer, not in ours. Get you to put in information or your passwords or whatever that allow a disastrous occurrence. And we try to watch it, and we can see something that's out of pattern. That why are they all of a sudden wiring all this money to Kazakhstan? But it's a challenge for us. We are very dependent on our own information systems already, and as we open them up to many more users, which we want to do for that convenience and for cost reasons, that challenge that you identify is exactly right.
Michael still has a plane to catch. And so we are so in your debt for your wonderfully enlightening remarks and your ability, your willingness to take these questions. And let's give him a great big hand.